Hi guys, Boris Dorfman, LBC Capital Income Fund. LBC Capital is a debt fund. I want to talk to you about the different types of funds that are out there, real estate and otherwise. If you're not following me, if you're not subscribed, please do so right now. As I promised my marketing guys that I'm going to do a lot more interesting content. So if you're not in, don't forget. And leave a comment. And if there's any topics that interest you, please tell me so in comments. I respond myself, and I'll do the next reel on the topics that interest you. So there's debt funds, and then there is equity funds. Debt fund is when the fund lends out the money. Equity fund is when the fund participates in equity. So in real estate terms, if somebody wants to build something or acquire real estate, and if the fund is raising money for such an event, such a project, this is an equity fund. If the fund is lending out the money and not participating in construction or the actual appreciation of the property, this is called the debt fund. LBC Capital only lends out the money. We can participate in deals, but for the most part, we are a debt fund. Now, there is capital preservation funds, then there is more opportunistic funds. There's different names for opportunity funds out there, but for the most part, in real estate world or in any investment world, there's capital preservation fund. What it means, capital preservation fund, it's not very adventurous, it's not very risky. Capital preservation fund is there to preserve your capital. It doesn't mean if you invest $1 million, the idea is to keep your $1 million at zero return. We're paying out 8%, sometimes more. The idea is for risk to be so low that your capital is preserved and your downside is extremely limited. As an opportunity fund, LBC Capital's downside is limited, risks are limited. Opportunity funds, that's something that I've been promised for over a year that I will roll out. I promise I will. I won't give you the date. But the second fund is more opportunistic. That means higher potential for return, higher risk level, and basically it's more opportunities. This is for our real estate industry, but also, think of the venture capital firms out there, angel investors. So opportunity fund is more risky. It has higher potential for return, obviously higher downside, possibly longer lock-in period, right? There's funds out there that hold land. Land is the highest appreciating asset class in real estate over long term. So there's funds that buy a lot of land, and after a long period of time, they sell it off, and it has higher return on investment than single family, multifamily, commercial, industrial, pretty much any passive real estate investment. Capital preservation fund and opportunity fund. You are going to allocate your assets, right? So if you want to be opportunistic, you can take risk. You have a lot of reserves, allocate a small portion to an opportunity fund, allocate a larger portion to capital preservation fund. The older you are, you probably should be taking less risks, obviously. And opportunity funds, typically they have a lot less liquidity. Thank you guys. Please drop me a comment, compliment me on my video, or critique my video. You don't like it, tell me. And I'll see you next time. Thank you.